This is the first recording on Chapter 17, the Statement of Cash Flows. Okay, the usefulness of the Statement of Cash Flows. So the Statement of Cash Flows was added in the 70s because there were a lot of companies that startup companies that started becoming listed on stock exchanges in the 70s, and a lot of these startup companies were going bankrupt, and investors didn't understand why that was happening. And they went to Congress and complained about this, and because of that, the statement of cash flow was added to the required statements. Prior to that time, the only statements that were required was the balance sheet, statement of owner's equity, and the income statement. So the addition of the statement of cash flows required the statement that explained to investors how the cash flows were different from net income under accrual basis accounting. So investors were generally more accustomed to looking at cash basis accounting than accrual basis accounting. So there was a misconception why companies that were profitable under accrual basis accounting did not have enough cash to remain solvent. So the statement of cash flow explains a company's ability to generate cash flows or future cash flows, and whether or not they have cash available to meet the future obligations and make dividend payments. It also explains the differences between net income under accrual basis accounting and their cash available from operating activities. It also explains how cash has been used by investing and financing activities during the period. So in order to understand the statement of cash flows, we have to understand what activities flow under or fall under operating activities, investing activities, and financing activities. So operating activities generally are items that are shown on the income statement. Investing activities generally are items that are represented by changes in investment accounts and long-term assets. So investing activities, we're talking about purchases or sales of long-term assets. And financing activities are changes in your long-term liabilities or your stockholders' equity. So financing activities would be sources and uses of debt and equity. So how is the company financing its activities? Are they borrowing from banks or creditors issuing debt, or are they issuing stock? So further explanation of this. So operating activities, these would be cash flows that are coming from the sale of goods or services. They could be interest received or dividends received. And for cash outflows, these would be payments for inventory items, payments for employee wages, payments for taxes to the government, payments for interest when we have interest due on amounts that have been borrowed, payments for expenses such as utilities or property taxes or supplies needed for business operations. So those would be different operating inflows and different operating outflows, cash outflows. Investing activities are changes to investments in long-term assets. So inflows would be from the sale of property, plant, and equipment, sale of debt or equity securities, so debt that we hold in other companies, so investment in other companies' bonds, investment in other companies' stocks. So when we sell those investments, those would be cash inflows, or when we collect loans we've made to other companies. And then cash outflows for investing activities would be the purchase of property, plant, and equipment, or the purchase of investments in other companies, or if we make a loan to another company. And then finally, financing activities are cash inflows would occur when we sell our stock, so when we issue common stock or when we sell our company's bonds to raise money. So when there's an issue of a bond or there's an issue of common stock or when there is a sale of our treasury stock. And cash outflows would occur when we make dividend payments. So this only holds for cash dividends. Or when we are paying off our long-term debt. So if we debt hits maturity or we have an early retirement of debt, you also would have a cash outflow if we acquire treasury stock. So if we go out on the market and buy back our own stock. The other thing you would see reported on a statement of cash flows would be significant non-cash activities. So sometimes we have a investing activity that is financed with a financing activity. So there's actually no cash flow that's happening, but there's a change to an investing activity and there's a change to a financing activity. So for example, you purchase assets, but you do it with stock or you do it by issuing bonds. So there's no cash flow happening, but there are changes to investing activity and there's changes to financing activities. And they're both important, but there's no cash happening. So they want to have it reflected on the statement of cash flows, but there really isn't any cash. So a conversion of bonds into stock, there's two activities happening in the financing section or financing activities, and they want it to be shown on the statement of cash flows because there's a lot of financing activity there, but there's no cash. When you issue debt to purchase assets or when you exchange one asset for another asset, there's a lot of investing activity going on, but there's no cash. So we do have at the bottom of the statement of cash flows a non-cash activity section where we report these type of transactions.